Okay, good afternoon. Welcome back, everybody, to today's Lunch and Learn. I am Joel Landon, your host. I'm from Heritage IRA. It's good to see you back here again. For those that are joining us live, we're also grateful for those of you who might be listening to this recording sometime after this live event. We always appreciate you taking the time to learn more about self-directing your retirement funds through an SDIRA or a solo 401k. Today, I'm really excited about our guest. I've known Rob now for a little while, and I've had a ton of fun interacting with him and his team. Rob, we're super happy to have you here. Thank you for joining us.
Thanks, Joel. Thanks for having me. It's a real pleasure and an honor. I appreciate it.
Yeah, absolutely. So, Rob joins us from Grit Partners. He's based out of Charlotte. I'll give him a chance here to talk a little bit about himself. But gosh, Rob and I, we got connected at a John Hire event last year. And we hit it off right away. There's a lot of synergies between what Rob offers at Grit Partners, in addition to just the experience that he's acquired over time. So obviously, it made perfect sense to bring Rob in here today and to have him showcase and really just share, what he's been doing, what he sees today with our current economic market, and what it looks like for a self-directed retirement investor or for any retail investor for that matter. So we'll get right into it here and go through a series of questions to help Rob unpack some of that wealth of knowledge that he has. And of course, towards the end, we'll have a Q&A. Anybody who has questions that's interested in asking us about self-directed retirement accounts or the Charlotte market or anything tied to what Rob shares with us today, we'll be happy to hang around and have that discussion with you, that Q&A. But of course, towards the end, Rob will also share some of his contact information so that you could get in touch with him, learn from him directly, maybe collaborate on some investment opportunities that he's always got available. So, with that being said, Rob, again, thank you for being here. Why don't you take a minute? Just why don't you share with the audience who you are, your background, a little bit about yourself personally and professionally, if you don't mind.
Sure. Thank you, Joel. I've been doing real estate investing in one shape or another for the past, I don't know, 20, 25 years, way before the Great Recession happened. I've had the honor of going through the Great Recession, uh, losing everything I had, rebuilt it back up again, and learned a lot about how capital markets work, securitization, and how, my opinion only, how it's a rigged game. Okay. And when you learn how the game is rigged and how the big players play and how the rules are set, you understand how to play the game a little bit better and how to play in that sandbox and to take advantage of very intimate opportunities so that you can get ahead in this game. So while it was unfortunate, I went through what I went through. It actually was a good experience for me going through losing everything. And if those of you that don't know my story, I have a book. You guys can get a copy of my book. But I went through a bankruptcy, Chapter 13, lost it all. Inside the bankruptcy, I actually sued two of the largest banking institutions in the world, won, and got a ton of money from them out of that settlement. And I started buying mortgage loans ever since. Started my distressed debt fund back in 2014 and learned a ton of how that business works. Done a lot of studying on the macro side of how debt cycles work, economic cycles work, real estate cycles, geopolitical cycles. And when you start looking at what happens globally from a macro perspective, you can put together a little bit of a mosaic of what's happening locally and know exactly how and where to strike with the right deals. And so it's been those unique experiences that I've had, and looking at things a little bit as a, well, not a little bit, I am a contrarian. I have an alternative way of looking at things. And as most people know, it's 10% of the population that runs 90% of the wealth out there in the world. And when you have that kind of disconnect and that disparity, that 10% know something and they do things differently than the masses. When the masses zig, they zag and they do things differently. And I operate in a similar way. And so some of the things that people are going to hear today are going to challenge some of their belief systems. of some of the things that I do and what I believe and what I see. But that's because I'm trying to be part of that 10% as well and zigging when everybody else zags. So I appreciate you having me on. And, full disclosure, I'm not an attorney. I'm not a tax advisor. I am not a financial advisor. I'm just a guy with some crazy ideas that have worked. And I love sharing my ideas with those that want to get as crazy just as I am. So appreciate
Yeah,
that, Joel.
of course. Yeah, I love it. I appreciate you going into some detail there. And I think it's always safe to say, yeah, this is all educational. And we're really just sharing some wisdom, when it comes to your expertise and what you've been through. It's great to see that you've kind of been there, done that. You've gone through bankruptcy, you challenged some of the biggest institutions, one, obviously, and then you flip that into opportunity. So, you come with the background and credibility, so we're excited to hear some more. I love how you said, some of the content that the listeners will hear today are potentially going to challenge their belief systems, and why not? Why not, hear a different perspective and take that on head first and see how it could potentially benefit you as an investor. So. Appreciate that, Rob. Why don't we get right into it? I know today's topic or theme really is investing through uncertainty. That was a discussion that you, myself, your team, even Mark, our CEO, we had in your office, just talking through how, markets are changing, times are changing. You being in the industry for 25 plus years, you've seen the recession, you've seen changes in markets. So why not dive into that a little bit today? Because it really is a sentiment that's going around or that others are talking about. So with that said, why don't we dive into thriving in the midst of market uncertainty? Why
Yeah.
don't you talk a little bit, Rob, about how maybe you've done that in the past or
Yeah.
some of the steps that you're taking to set yourself up for success, or even what some of the other investors in your circle are taking to thrive in these types of conditions?
Well, things are definitely changing. I think we can all agree that the times are changed. We live in a time of chaos, conflict, and confusion. There's a lot of that going on out there, on a number of different levels. Uh, and we live through this and we want to make decisions for building our wealth, building our future, our legacy, and our security. But as the winds of change, pick up and it doesn't make things very easily or things very clear. Things aren't the way they used to be. So what I like to do is I like to take, let me say it this way first. A lot of information that we absorb in order to make our decisions, a lot of that information is data points of the past, meaning they're all historical, right? A data set that you look at of performance of this or that, or whether it be a particular asset, a market, or this or that, that's past performance. We can see that because it's happened. And by the time we see it, the opportunity is gone. The trick here is to see what's coming. And it's not so easy to see what's coming. In fact, I don't know anybody who can actually predict the future, right? Unless you're somewhat clairvoyant. I don't know any of those people that are clairvoyant that knows exactly what's going to happen when. So anybody that tells you that, hey, we're going to forecast this or that's going to happen, they're not telling you anything that's true. It's just a belief. Same for me here. Anything that I say is going to happen today, that I think is going to happen, it's just my belief system. I just happen to have been right more than I've been wrong, and lucky enough to profit off of that. So that's why I continue to go the way I'm seeing things. And here's the way I do it. I look at particular data points, some stuff in history, and you put mosaic together. And what do I mean by that? So let's put a little bit of a picture of what I've seen. Let's go back to 2008 during the Great Recession when that happened. Okay. That happened because of a subprime crisis where banks were lending to people that couldn't afford to pay these loans. And they didn't really care, the banks, because when they sold them off in the secondary markets, there were other investors that were left holding the bag, and the banks didn't care because they got paid. Okay. Government comes in, bails them out, takes all of the risk, and the Fed started going into quantitative easing and taking some of the risk onto their balance sheet as well. What did investors do at that point? Oh, they stayed away from investing in residential. It was a problem. Then they started getting into let's do multifamily. And the Fed lowered rates. And we lived for about 10 years in what they call the ZIRP, the zero interest rate period. So money was cheap, money moved into multifamily, and all of a sudden, all these multifamily operators were out there doing well until 2022 when rates shot up through the roof, and all of a sudden, multifamily now gets to be distressed. Right now, there's about, I want to say, $1.2 trillion of multifamily debt on the books of commercial banks that will come to maturity in the next 4 years. Okay? 600 million of that, I'm sorry, 600 million of the 1.2 trillion is multifamily that'll come to maturity in the next 4 years. Those are loans that have interest rates sub 5.5. And if they have to come back out to refinance, they're going to get into an environment where interest rates are a lot higher, which means that those loans don't pencil anymore the way they used to. 70% of those loans are held by commercial and regional banks. So there's a problem there. A lot of the banks are walking away from that business. It creates a gap, and we're going to have another layer of distress coming, especially in the multifamily. So the bankers, our government, they all know this problem exists. We have another challenge when we went through COVID, where in 2022, the stock market returned a net minus 16% return. Okay? Government came up with a whole bunch of the Inflation Reduction Act and all sorts of act to pump more money into the system to give corporations so a lot of corporations could survive throughout COVID. More debt into the system. Inflation shot through the roof. Who ended up paying for it? You and I ended up paying for it. And the fact that, our eggs and milk and gas went through the roof. So we end up paying for it. So we're challenged with how do we get our portfolios to grow at a pace that's faster than inflation and our purchasing power gets eroded. Our purchasing power gets eroded through inflation. And so in order to stay afloat with our lifestyle the way we want, or even to get ahead, that means we have to counter that force of purchasing power erosion. We have to counter that with good decisions in our portfolio so that we can make returns that outpace the erosion. It's not easy to do. So in 2022, when that new debt came into the system, the market returned a negative 16%. And something interesting happened that year as well. For years and years and years, traditional financial advisors were telling people that you have to have a model portfolio, 60-40, 60% in stock, 40% in bonds, and that'll give you a good balance so that as the market fluctuates and we go through events and this and that, you will be balanced. Well, in 2022, in the midst of COVID and in the midst of that cash infusion, that's the first time ever. Let me back up before I give you the punchline here. Let me set this up a little bit. So for the last 40 years, when you did that 60-40 portfolio, that was the playbook that traditional advisors used because there was a negative correlation between stocks and bonds, meaning that when one went up, the other went down, and when the other one went up, the other one went down. So it was a negative correlation, so you had a good balance. Okay? There was a negative correlation. That's what negative correlation means, is that when one does one thing, the other one goes the other way. And that's how you keep your balance. Well, in 2022, that correlation between stocks and bonds turned positive. So when one went down, the other went down. And so structurally, that concept collapsed, especially when we needed it in the midst of a pandemic. And so a lot of investors saw that, saying, wait a second, this doesn't work. We need to change our playbook. The second thing that's been happening, the second dynamic in the market's been happening, is that a lot of productive companies are not going public anymore, or actually coming out of the public market and going into the private markets. So we want to do that structural 60-40 balancing act. Well, the quality companies that we want to invest in are not in the market anymore. They went private. So we're left with all the leftover junk companies that have a lot of risk and have correlations to bonds and all that stuff. So it creates a big mess. So this playbook doesn't work anymore of 60/40. So now we're left with, well, now what do we do? Now we got to go private? Great. So now, a new executive order was put out that all the 401ks can now get into alternative investments. That's good, except who's going to make the decision as to what's a good investment and what's not? So now it puts more burden on us. And let's face it, we didn't all go to finance school. We figured this stuff out as we go. No one taught us how to do this. So now we have debt to GDP at 125%. And what that means is simply this is how I explain this. Why is that important? Well, whether it's yourself, or I use the example since I have two children, I use the example of my children. Do you want to teach your children to get themselves in credit card debt without a job? They can't pay for their debt? No, that's basic rule 101, right? You don't want to take on any more debt that you can't afford to pay off. You want to have more money going into your pocket than coming out of your pocket. And so our country, our GDP is how much money we make through production, and our debt is at $38 trillion dollars, and our debt to GDP means we have more debt than we can afford to produce and pay off to the tune of 125%. So we're basically insolvent. And this is the first time we've been at a debt to GDP of 125%. First time we've been there since World War II. Why? Because of all the debt that we have in the system, because of all these events that have come into play, because, again, for another bunch of other reasons. So you see all this stuff happening. So what does that mean? We're being drowned by debt. And when the governments get in trouble, they can either tighten up their belt and lower their spending or print more.
Yeah,
So
and we're seeing so much of that. And
that's right.
before you keep going, because I know you've got so much to share, and it's great. It's phenomenal information, and I love how you're essentially leading into how the playbook is actually being rewritten because of historically what's happened to our country, our economic situation. I wanted to highlight and almost share that there's a synonymous message here that you just shared with me that we had with a registered investment advisor that we're partnered up with last week. And, this specific partner who's essentially been managing, a book of business of high net worth clients for a while now, over 30 years. And, they're leveraging our services at Heritage IRA so that their clients can actually invest in these private placements, something that this registered investment advisor fully believes in. And it's becoming more and more, I guess, popular might be the right word. And again, it ties into this concept of people are rewriting or
Yep.
investors are rewriting the playbook. It's no longer, like you said, the 60/40
Nope.
split. So it's really synonymous with what you're saying. We just had a conversation with a registered investment advisor last week about this. And okay, Joel, Heritage, how can you guys help me as I'm positioning my clients into private placements that he's vetting, that they're sourcing, and that they believe in, to make it as easy as possible for these
Yep.
retail investors and their retirement funds and even their cash accounts. So it's
Yep.
it's very synonymous. Didn't want to
Yep.
cut you off, but I felt like I would just add that in there,
No,
Rob.
you're absolutely right because
Well,
that's the reality of what's going on today. Because then that's exactly what's happening is that people are looking at this and saying, okay, now we have to do more alts, more
yeah,
alternatives, more private. We got to look at some private placements, maybe, or do it in direct investments. There's a whole number of ways of doing it. But the challenge then becomes is how do we analyze the risk? How do we analyze our risk tolerance and then match that up with what we're investing in, right? When we were in the public markets, there are ways of doing that with ratings and
yeah,
who's got a rating on this and who was doing a bond rating and who was had all sorts of stuff. You had a lot of companies that did that for you stuff. But now we're going to the private. The data isn't as transparent, and there are ways of doing it. There are ways of doing a lot of that stuff, and there are people out there that do it. I advise on a lot of that stuff on how to assess this. But you see more and more, exactly as you're saying, that more sophisticated investors are moving away from the traditional RIAs, the traditional advisors. We want to get more into alternatives. And I'll give you another little scary thought too. There's something to the tune of $120 trillion of wealth that's going to be transferred from the baby boomers to the next two generations in the next 15 to 20 years. Okay, that's not the scary part. It's a lot of money being transferred, right? I'll give you another little fact. 67, we'll call it 70%, a large chunk of that money was created since the Great Recession. Less than 15 years old, that money is. Okay? 70% of that money is less than 15 years old. Okay? When the money is being transferred, only 22% of the families are actually having a conversation around money from
That's
one
sad.
generation to the next.
Yeah, that's
Okay?
sad.
And so that's part of the scary part is that all that money and all that wealth is going to be transferred, and 78% of that money is going to go into hands that have no idea of how to manage it. Okay. And don't think these institutions don't know that. That's why they're setting up a lot of platforms where you can trade right on your phone and you can do all sorts of things and make it easy. Absolutely. A lot of these institutional platforms are coming into play because they want to take advantage of that money and they want to get their hands on that money because people don't know any better. And so it becomes a challenging time. So that's why the people that are listening to this, they come to you and they talk. Those are the people that want more. That's why I enjoy doing these types of presentations and stuff because people want to learn more. There is information out there, and you got to hook up with the right people, and constantly learning. It's always important to constantly learn and see what's going on. So yes, people feel that something's changing. The playbooks are changing, and it just has to get more and more education. Education is what's missing out there now, especially for that 78% of that money that's going to get transferred. The education piece has to get out there, and people need to learn more about what's going on.
Love it. You know, you and I, we've had some conversations offline, and we talked a lot about, the opportunities that you're generating and that you're in front of. I want to throw a question out there for you just to kind of get you sharing a little bit more. But, we talked about tightening bank credit and just how
Yeah.
bank credit is certainly becoming, harder or not as accessible. Money was cheap a little while back, like you brought up. We had a good stint where money was pretty cheap, but is the tightening credit, is that becoming an opportunity for investors in your eyes? And if so, how do you see that? Like, what do you forecast? What are you seeing right now with investors, maybe even in your own circle, when it comes to tightening bank credit?
So look, I look at most things in life are a trade, meaning there's at least two sides to everything we do in life. Because most things we do in life are transactions, right? Right now,
Yep.
it's a transaction of information, right? We trade off time for education. People are coming in and sacrificing some of their time during this hour to listen and get some education. Hopefully, we're providing good education. Hopefully, we're delivering. Um, so when an institution or a bank exits a space, I look at the other side of the trade, right? That just creates an opportunity for somebody else to step in. When banks and institutions start tightening up credit, I look at the other side of that trade. That means somebody else or some other organizations can come in and fill that gap, right? We talked about today, like yesterday, with my team. Um, well, there's a lot of private lenders and private credit real estate funds in the country today, but they all sell the same stuff, and it's all basically institutional type products. Okay. I was talking with my team yesterday because we're rolling out a private fund, a proprietary fund as well on private lending. And we talked about offering no payments for 12 months, 0% interest for 12 months. um, because there's a need for that, there's a space for that, and the institutions aren't doing it. Even though they're private credit funds, they're still institutions that are backed by them. So they still think institutionally. And so they will fill a gap and get crowded in that space, which leaves little niches for boutique companies like ours to fill in and serve a need. And that's one of the ways where you can get and gain more return because the big companies work for this much of a return, whereas the boutiques can make this much of a return. That's studies have gone on for years about that. That if you're really looking for for returns, you want to go more for the boutiques, not so much for the institutions. The institutions just to have too much capital to drown out all the yield that are in particular deals. So the boutiques are where you're getting real value and real yield for your investment. And that's what people need to look at today. Because again, going back to the inflation and the forces that are out there eroding our wealth, eroding our purchasing power, we're in an environment now where we have to counter that with deals and opportunities that give us more yield just to balance out our lifestyles. So once things calm down, which I don't think it's gonna be anytime soon, but they will. They will. I just think we'll have to go through a period of chaos for a while. How long that is, I don't know. I just think we have to go through it. That's just a natural cycle. But once we get through it on the back end and go through a peaceful, calm period of prosperity, then we can get back to, all right, we're only looking for this much yield as opposed to this much yield because inflation will come down, we'll have some stability, we'll have some clarity, and we won't need to go after the bigger yields. Um, but some people more yield means more risk. True, but there's a number of ways to set it up where you can maximize your yield and really minimize or push away the risk, where you're taking very little risk and getting a lot of upside. But that takes, some skill and some craft to do that. But it can be done. And people need to start looking for that and how to do that, or work with people that do that and how to do that. Which
I
is
love
why,
that.
again, one of the ways of doing it is doing through the IRAs, right? Because taxes are a way where they come and they minimize our growth potential. So you want to put things inside, you want to do some of these investments inside of an IRA where that tax erosion is mitigated out of the way. All right, but that's
Yeah,
just one
I
risk
love
that you
that.
want. There's other things, there's other risks that you want to look at and minimize as well. But doing it inside of an IRA is a start. That's where you want to start.
We have so many individuals that are either in a self-directed IRA today because they want to invest in private opportunity. They want to be a part of the new playbook. There's folks that, are curious that maybe they're on the sideline and they're just curious about what's out there for me, what opportunity is available to them. And I think, just like you talked about with tightening credit, opportunities are emerging and they're out there and they're available. Rob, you're in a unique market. You talked about Charlotte. You've talked about the opportunity there while we were out there visiting you. And I was curious, just we don't have forever, but if you could even talk through what does that opportunity look like for you as an operator or somebody that is in front of this opportunity so that those sitting on the sideline or those who have capital within their self-directed IRA ready to deploy, could you break it down for them? Could you give them some
Yep.
insights? Feel free to even go through case study if that's something you want to do.
Oh yeah. I mean, look. So here's I'll start it with this, and I'll bring it full circle around. Okay. As I said before, we go through cycles. The phase and the stage of the certain cycles that we're going through now. We're going through, and we're just in the beginning of the deleveraging part of the cycle. Okay. We've levered up on corporates, on government, and on consumers. Too much debt. Everybody's over levered. Now we got to get through a process of delevering. How do we delever? Well, let's talk about that. Okay. In for what we're going through now with all the inflation and deleveraging process, the sophisticated money now is moving away from financial instruments into real assets. Not so much real estate, but real assets, meaning precious metals as well. We'll talk about, and I'll keep it simple because I don't want to get into too much of the weeds about what all that means and stuff, but we'll just keep it simple. Here's my philosophy and what I'm doing. I'll tell you what I'll do. I'll tell you in the way that I'm doing it. Okay. I
Please.
do, I'm doing two strategies now. I'm using private credit, private real estate credit, origination and distressed credit to create new money for myself. And then I'm putting it into precious metals to preserve the value of that new wealth. So I'm doing wealth creation and wealth preservation simultaneously on a barbell. Okay. And right now, the wealth creation in this phase of the market and deleveraging is getting away from financial instruments. Now, remember before I said there's always a trade as people are getting
Yeah.
out of um, new originations, making new loans, commercial lending. People are getting out of that, institutions getting out of that. That means there's opportunity to get into that as well. So, two things that we're doing. We're doing new loan origination. We're doing it specifically in Charlotte and the Carolinas specifically, and I'll tell you why in a second. I'll circle back to there. So we're doing new loan originations, and then we're doing distressed loan acquisition, meaning this. There are a number, and this number is going to continue to rise. There are a number of banks, hedge funds, private lenders that have gotten themselves into some sort of hot water. Number of reasons why they've gotten into a problem where they have these loans that they're not getting payments on, non-performing loans. Those trade at a discount. You can get those at pennies on the dollar. We do. We've got access to that. So and let's go through an example of that. I'll give you a perfect
Please.
example.
Yeah.
Okay, not too far from where I live, there was a builder who was putting up multifamily, was putting up, I'll call it 300 units. It was. Okay.
Okay.
And I'm doing this off the top of my head, so I don't know if my numbers be 100% accurate, but I'll do this for
It's
illustrative
okay.
purposes. Okay. I
Yep.
valued the property would have been about 70 or 80 million dollars once done. It was going into foreclosure for 57 million dollars on the first lien loan of that property. It was about 90% done, and the developer was losing it. That loan, I want to say, sold for about $40 million dollars. Now think about this. You pick up that loan at $40 million dollars, and it needed maybe $10 million dollars more to finish it off. Your cost basis into that thing would have been $50 million dollars on an $80 million asset. Okay?
Significant.
Foreclosed and doing all that. Now, if you get into there and you have such a low basis, part of the issue we have an affordability crisis today is you think about how this works. On a multifamily property, we have to get high occupancy, we have to get rents in, we got to do market rents. And if people don't have the jobs, not even just the jobs, but let's say the income and the wages, because their lifestyle is so expensive now with eggs, coffee, gas, and all the stuff, they don't have enough money left over to pay rent. So paying, let's say, a $1,500 a month rent, they can't do it anymore because their job doesn't pay them enough to afford that lifestyle with all the inflation that's come. So now we have an affordability crisis that people can't afford 1,500 bucks to pay rent. But now let's go back to my scenario. If we're in such a low basis and $50 million on an $80 million asset, I have the ability now to lower that rent to $1,000 a month, make it affordable for somebody, increase my occupancy rates, okay? And I can still hit my numbers. I can still hit my returns, my yields, my safety, my margin of safety, all sorts of things I can do because I didn't play with the NOI on the income side. I played with the NOI on the expense side. I just played the other side of the balance sheet. And so that's what deleveraging looks like is buying these assets, not directly, you're buying the underlying debt at a big discount, and then you pass that discount, part of that discount, you pass part of that discount along to your tenants so they can get in, they can have an affordable place to live, and you're still hitting your numbers. and you're still making a great return. So for us, we're still hitting our great yields, which is combating the inflation in my life that's eroding my wealth. So I'm still hitting what I need to do, and I'm putting out good product into the world where people can be more affordable. So I think you're going to see more and more of that. Why do I like it here in Charlotte? Because, as I said before, the tenants need to have jobs. Charlotte's got one of the fastest growing economies in the country. The Mid-Atlantic in general has got some of the fastest growing economies in the country. And so when you look at, we're going to go through a phase of distress in the country. When you look at who's going to bounce back up economically the fastest, Charlotte's at the top of the list. The Mid-Atlantic region is at the top of the list. They're going to come back out of the recovery quicker because you got new manufacturing jobs coming here. You've got other big corporations coming here. Another multinational company is putting up their headquarters here, I found out yesterday, and another one, a global one, is setting up headquarters here again as well. So you have the influx of people. You got people coming from the Northeast. You have people coming from the Midwest. You have people coming from everywhere here. And that creates a good, stable local economy. The employment rate is under the national average. Wages is above national average here. There's so much more opportunity because specifically here, Charlotte's a quiet little gem. It's not really on a lot of people's radar. Okay, but you see big builders coming in. But the challenge here is the infrastructure is not being built as quickly as people think, which again creates some distress, which creates opportunity. So there's a lot of opportunity here, niche opportunity that helps investors like us to get that expanded yield that we're looking for in an environment where inflation is eroding our wealth. I'm going to keep going back to that you want to look for those safe opportunities in particular areas. And that's why I like Charlotte, because Charlotte offers specific, unique opportunities for people to get that expanded yield with low risk that can combat the inflation that we're dealing with on an ongoing basis. So I don't know, I went in a full circle that way, but I hope I explained
You
it
did.
clear
And I
enough.
want to, I feel like that was such a good example of, like you said, distress loan acquisition. It was an opportunity for you or any operator and group of investors to come in and ultimately save an opportunity, an investment opportunity, or really a benefit to the community, being that it's housing, for those residents of Charlotte or the surrounding area. So I love that opportunity and that example. And I will say that this is an ideal asset that a self-directed IRA owner or a solo 401k owner would actually
Yep.
invest their retirement dollars in. And
Yep.
they could do that with pre-tax money in a traditional IRA and preserve, or let's just say defer the taxes for later, but preserve that capital and preserve those earnings over time, 10, 15, 20 years, and not have to worry about losing out on the tax burden every single year because they're doing it within a tax advantage account.
Yep.
All the better. Let's say you have an investor approach you with the self-directed Roth IRA. They see the opportunity, again, going back to your example, purchasing the property at a discount, $40 million, 10 million to get it up to, up to snuff, if you will, so that you can get your renters in there, bring renters in at a favorable rate. Now all of that income going back to the self-directed Roth investor is going back tax-free. So not only are they not paying any taxable burden on those earnings 5, 10 years as they hold the asset or multiple assets like that, when they distribute in retirement at 59 and a half, they're not having to worry about any tax on those distributions, or even better, the money that they're earning, whether it's a pre-tax IRA, traditional, or a Roth IRA, maybe they don't even distribute their earnings in their lifetime, but it's an asset that they can, or it's money that they can leave to their
That's
legacy.
right.
So
Yep.
just a perfect example. And I'd love for you to even talk through, you mentioned new loan origination. Talk to us about
Mhm.
that if that's okay.
Yeah, yeah. That's like any other private lending. We do it a little bit differently, where we are a little more flexible in our underwriting, meaning that look, there's a lot, like I said, there's a lot of traditional institutional money out there doing the regular fix and flip, DSCR, ground up, and all that stuff, and everybody has that plain vanilla stuff. Okay, but there's still um, a segment of the market that is still valuable that needs to go beyond some of those traditional underwriting guidelines. Okay, some of it is gap funding. I've done gap funding for years, and I'll tell you that that's as simple as um, an investor comes up, and I'll give you the perfect example again. Let's do it through an example. Okay. I sent out one of my guys yesterday to go do door knocking, and I'm showing him some of the properties he's about to go to. There are properties here in the Charlotte area that are worth $400,000 today, and they're being foreclosed for $40,000. Okay.
No way.
My guy said to me, that can't be true. And I said the same thing when I first got here. And I talked to a few people and a lot of attorneys. That can't be true. And what we found is it is true. What's happening is you have people that have lived here in certain pockets, for 40, 50, 60 years. And they bought the house when it was $10,000. All right. And because of all the growth that's happened here, the house is appreciated. They may not know what that appreciation is because they've never refinanced. They just live there, raise their kids, and simple people that just go to church, go to work, and just love everybody in the neighborhood. And they've done that for the last 50 years. And the houses and the neighborhoods have changed, and traffic has, gotten tighter, and the house has gone up. And yet they can't, for whatever reason, can't continue to pay their mortgages, and they run into a problem. Now, if we had a guy that walks up to them and wants to work out a deal with them, help them in the foreclosure, there's a number of ways to do that. I won't get into that here, but if that guy finds the right deal, um, a traditional, but he doesn't have any of his own money to put down into the deal, a traditional private lender will not lend to that opportunity. Okay. We'll look at something like that and we'll talk about, well, maybe there's an option to write. Maybe there's a second mortgage. Maybe there's an equity JV partnership we'll go into. Okay. All of this is part of financing, whether it be equitable financing or whatever it is. There's a number of ways of doing it. But those are opportunities that are out there that are safer, have more margin of safety, and give you great yield. Going back to the theme again, if we want to get good yield at a low risk profile, there are deals like that all day long around here doing stuff like that. So when we see stuff from 40,000 to 400 and then 40 million to 80 million, that's when I tell you one was 10 minutes from my house one way and one was 10 minutes from my house the other way. Okay, there's all of that here because we're going through such a change here and such a growth spurt, but it takes a long time to get to this growth spurt that you have a lot of this infill that's happening. And that's not just here. Now you're talking about Greenville, South Carolina is going to start booming now too. Spartanburg is going to start booming. Charleston is going to start booming a little bit more too, which already has been. It's crazy. There's a lot going on in the mid-Atlantic areas with people coming in and a lot of growth and a lot of change, which creates a lot of opportunity.
Fantastic. You know, Rob, we're here 15 minutes to the top of the hour. Yeah, I'd love for us to start just kind of winding down and uh, delivering essentially the last uh, words of wisdom, if you will. So if you wouldn't mind, before we open it up to any questions that might come through, why don't you tie a bow around this? You know, you've shared quality information specific to, changes in the market, specific to the Charlotte market itself. You've demonstrated some specific alternative assets available to self-directed investors. How would you tie a bow around this messaging? And ultimately, how should people get in touch with you and continue the conversation,
Well, I'm going to say two things first.
please?
If I could tie it up, two quotes that stay in my head constantly that drive my philosophy in my business. Number one was by Einstein, where he said that Compound interest is the eighth wonder of the world. Those who understand it earn it. Those that don't pay it. Okay.
Yeah.
And so, with that, inside of real estate, being on the credit side of the capital stack, not owning the real estate, but owning the loans on the real estate, okay, goes to that point there. I'd rather collect interest from my borrowers than pay it to any other creditors. The second one that I stick with, that keep with me is, um, oh my God, I just totally lost that out of my mind.
It's
Control.
okay.
You want to control? Oh, that's it. Own nothing, control everything. And I think it was um, JP Morgan that said that. I got to look up the quote. Who said? I just remember that that's what it was. Own nothing and control everything. What does that mean? When you own things, that means you're subject to tax. Do we really want to own things or do we want to control things? If you think about it in the framework of real estate, a real estate landlord or investor, if you want to call them, they own the real estate, but do they really control it? As a private lender, I technically control it because think about this. Let's say you and I were doing a deal, Joe, and you were the investor and I was your private lender, and you was it was a 4 unit multifamily, and you're getting $1,000 a month rent. And you borrow the money from me and you have to pay me $3,000 a month. Okay, that's traditionally how people taught how to do real estate. Make a gross income, and then you pay off all your expenses, and you're making the spread. You're making $1,000 a month. You're a passive real estate investor. You're great. You're going to become wealthy and retire on the beach. That's the dream that everybody gets sold, right? Okay.
Yeah.
But what happens when two of the units go vacant? Okay, you got to come up with either the money or find new tenants. I don't care. I still get paid my $3,000. I don't care that you have that problem. What happens when a storm comes and a tree falls on your roof and you got to repair the roof? That's got to come out of your pocket. I don't care. I still get my $3,000 a month, right? And what happens if there's a slip and fall or something happened? And you got all sorts of responsibilities. Or what happens when the insurance price goes up? Or what happens when taxes go up and you got to pay more on the taxes? I don't care. I still get my $3,000 a month. So you have all of the headaches, and then you always have to make sure you're supporting me. I'm the one going out on the beach drinking the Mai Tais and stuff, and everything. I just care that I get my check every month. You're the ones that's taking care of all of it, right? And what happens if you don't pay me? I'll just happily take the house away from you via foreclosure, and I'll give it to somebody else who can manage it better than you and pay me my $3,000 a month. So I control the deal without owning it because I contractually get my $3,000 a month. And if you don't give it to me, I take it away and I give it to somebody else who can perform. Okay. So being the lender, having the collateral, taking less of the risk, having contractual income to know that I'm going to make this much money. Okay. Moving forward, making this yield. I have better, I'm postured in a better position to do what I'm trying to do and create that new wealth in the environment of high inflation. So you want to control everything without owning anything. Sure, eventually you end up owning and stuff and everything too. But now what we're doing through this distress, the leveraging cycle, you want to get to owning the real estate because the inflation will prop that price up. But you want to get there by owning the debt, through the debt, a different way. Most people are going after the actual price of the property, the asset of the property, and they're paying high prices, and you're not getting any value, any yield because everybody's bidding it all up and overbidding. And when you see a crash that's about to come, and people start losing. So if there's a 35% crash and price correction in housing, I'm not saying there's going to be, there will be some price correction. I don't know if it's going to be 35, but let's say if it's 35%, that's one thing. But if I'm buying the paper at pennies on the dollar, let's say it's just 50 cents on the dollar, I can absorb a 35% correction in price. And I'm still not going to lose. So there's so many reasons why owning the paper and controlling the real estate is such a better play in this phase of the cycle that we're in. When we get through this phase, you're going to hear me say something different. Own the property, own the property, own the property. Not in this phase. This is not the time you want to own the property. This is the time you want to own the debt to start amassing positions and control in property. And then when the cycle changes, you'll see it grow vertically. But
Rob,
today, you don't want to own the paper. You want to own the paper, not the property.
we appreciate the insights, Rob. Thank you so much. Obviously, you've got, the experience to share what you've mentioned, and I had to Google it. It was Rockefeller that made that comment about
It was
own
Rockefeller. It was one
nothing,
of those
control
guys.
everything. Yeah.
It
So,
was one of those guys.
yeah, I appreciate you putting this up. If anybody listening today is curious about having a deeper conversation with Rob one-on-one, feel free to scan this code here on the screen and reach out. And gosh, Rob, I want to say you mentioned that you have something that you
I
provide.
was just going to say
Go
that
ahead.
I wrote a white paper on this topic that is free for anybody. That if you scan that code, you'll get the white paper for anybody that wants to kind of read a little more. And there's a way to contact me and have a further discussion as well. So that QR code will get you that white paper. I wish we had more time because I love talking about this stuff, but there's only
Sure.
so much we can do in the 45 minutes. But so there's more on the paper with some more data, with some more insights on this as well.
Fantastic. So this is an opportunity for anybody that's listening live in the moment. Feel free to ask questions. You could leverage the chat feature. We've got that open to everyone. You can submit questions if you want to ask in the moment. We'll stick around here for just a moment, but we do appreciate everybody that's taken the time to listen to this information. Again, this is one man's experience. It's educational. This is certainly not financial advice by any stretch of the imagination. And of course, if you're interested in self-directing your retirement account, or if you know somebody that is sitting on retirement funds after leaving a previous employer, and they could benefit from investing in alternatives, have them reach out to us. You can send them to our website, heritageira.com, and they can book a consultation with us. If they mention Lunch and Learn, they'll get a discount at sign up, or you can get a discount at sign up if this is something that you're exploring for yourself or family members. So we're grateful that you were able to come and join us today, Rob. Again, it's been a pleasure getting to know you since last year, and looking forward to having you come back and maybe picking up where we left off today and sharing more. Or who knows, maybe when we have another conversation, things shift a little bit. And it's all about owning, like you said, rather than just controlling at that point.
Well,
So
I hope not, because I think that shift's not going to happen for a while. I hope it's not a long
I hope
time before I
so.
come back and talk with you again. So
That's
hopefully we can
right.
talk
Yeah,
more about this, about
we
how the
will.
next little movement happened.
Yeah, we will for sure. Well, we don't have any questions. Rob, thank you so much for joining us. Any parting words before we sign off here?
Um, Control over
Yeah,
ownership. Just always
cool.
remember that control over ownership. So, yeah, if anybody has any other questions, just, feel free to reach out to me. I'm usually pretty available and love talking about this stuff in case people haven't realized that yet.
Wonderful. Awesome. Okay, Rob, we appreciate you being here. Thank you, everybody, for tuning in, and we'll go ahead and say goodbye. Thank you
Thanks,
all.
Joe. Take
Yep.
care.
Bye-bye.